Hi, I want to welcome everyone to today's webinar. Thanks for joining us. We have Will Bosta here with why real estate investors should love digital real estate. Quick disclosure, Camaplan does not endorse any investments, give tax, legal, or investment advice. Consult with your accountants, attorneys, and other professionals before making any decisions. This is my contact information for anyone that's looking to use a retirement account and make tax-free or tax-deferred income. A little bit about Will. I'll go ahead and turn it over to him. He can tell us a little bit about yourself, Will, and then I'll stop my share.
Yeah, absolutely. So I am currently right now in our office in Los Angeles. I'm the co-founder of Attendees. We're essentially an e-commerce growth automation company. We take clients' investments and we build profitable e-commerce assets for them. My background is primarily in the tech industry as well as e-commerce. We've been doing this for about 3 years now. I've got about close to 500 clients, millions in revenue, and pretty much it's a highly evolving industry, but we're a pretty innovative company. And so I'm here to really talk about the industry as a whole and how to sort of tap into the market, especially given the current economic state.
Awesome. Thanks for joining us.
Absolutely. Happy to be here.
If you want, you can go ahead and share your deck.
I can. Great. Awesome. Sorry, I just was waiting for my cue here. Give me 1 second. Okay. I apologize. There's a Zoom privacy thing I need to fix real quick because it's a brand new computer. So bear with me for 30 seconds.
Yeah, no problem. Always something with technology, right?
Always.
We'll get there though.
Actually, yeah, for some reason, give me 1 moment.
No problem. We're here for you.
Worst case scenario, I can just shoot you over the deck as well, because it's public. Because for some reason, the Zoom, it's a brand new computer I got right here, and for some reason, it's not letting me share it, share my screen. If you don't mind, I'm actually
send it to my Gmail. That's going to be Fisher.
For the sake of time, I actually will just send it right here in the chat. That's cool with you.
Oh, okay.
It's just a quick link here, and it's public. Let me know if that should work for you.
Okay. And I need to get back here. Share screen. Do this.
There you go. So if you just go to slideshow up top, that should put it in the full screen.
Where? Right here?
Slideshow to the right of that.
Oh, yeah.
Yeah. Awesome. Sorry about that delay.
No problem.
So obviously today we're going to talk about e-commerce. Obviously everyone's familiar with what e-commerce is, and those two third-party platforms, marketplaces, Amazon.com and Walmart, are going to be the heart of what we're sort of discussing here in terms of e-commerce growth and really tapping into this market specifically. So let's go to the next slide here. I know we already, you just want to click next, should slide over. There you go. We already did a little bit of intro myself, but I've essentially been in e-commerce for about 7 years, as well as real estate. Our company, Attendees, has done about 75 million roughly in revenue so far for our clients. And so the topic today, essentially an Amazon overview about Amazon's growth, e-commerce growth, the supply chain model as being a seller with Amazon, product sourcing models that you can do, diversification within sourcing products, risk mitigation across the platform if you're involved, and then really how, as an investor, you can get involved sort of hands off. That buzz term Amazon automation is essentially what our company does. And I'll dive into that a little bit further towards the end. So e-commerce in general, it's a massively emerging asset class. Surprisingly, it's only 16% of the retail sales market right now. Surprisingly, I mean, I personally shop 90% of the stuff besides some groceries. I shop online, but right now out of the retail sales market, it's only 16%. NASDAQ predicts by 2040, it's going to be 95%. Even if there's a margin of error there at 15%, 80% of all sales taking place online is huge in the next 15 to 20 years. And you can see right here, 2022 is the year that it's actually crossing over the 5 trillion mark in terms of an industry numbers, which is huge. And even with, obviously the current state right now, it is growing. It might be growing a little bit less given, inflation and the economic downturn that we're in right now, but there still is growth regardless. We're looking at about 6 to 8% growth from last year's Q4 in this year's Q4, even with what's going on right now. So that does tell you something. It tells me that no matter what, people are buying stuff online, whether it's impulsively or for necessities. It's not all about buying clothes and stuff that you just want. It's also about buying necessities, detergent, food, stuff like that. And that's why this growth, people are becoming more comfortable with the idea of purchasing online. So yeah, we can jump to the next. So essentially, in 2022, this is actually, I apologize, it's actually 2021. So it's going to be more than this, 104 billion in third-party seller revenue on Amazon. So when you see those prime trucks driving around your neighborhood every day, one might think that that is actually Amazon's products. Yes, they are coming from an Amazon warehouse, but a lot of the time, over 50% of the time, they actually are owned by third-party sellers. So they're getting fulfilled by Amazon out of their warehouse, but those products are owned by a third-party seller like our clients. And that's over 50% of Amazon's online e-commerce revenue is by third-party sellers. So that's the heart of Amazon.com's revenue. Obviously, if you take away Amazon Studio and Prime Video and stuff like that, it's averaging about 66,000 orders per minute online. Huge numbers, probably not too surprising, given Amazon is just a beast in the industry, but it's just good to put that into perspective. So there are two ways you can be involved as a third-party seller. We have number one, which is FBA. That's Amazon's obviously bread and butter. That is Amazon Prime. That means fulfillment by Amazon. Therefore, you are sending products to Amazon's warehouse to then be fulfilled by them when when a customer purchases it as a Prime product. So if you go online right now and you have a Prime membership, you get access to that 2-day shipping, and you pick a product and you purchase that. Yes, it'll get shipped in the Amazon truck and it'll come here in 2 days from Amazon, but that is getting fulfilled by Amazon, but most likely it's owned by a third party. Hence, someone like our client or someone who's doing this kind of fulfillment method. Then there is FBM. FBM is you have access as a Prime member if you're buying that, but it's also for people who don't have Prime memberships. That's where you'll see shipping times are going to be above 2 to 3 days. They're closer to the 4 to 6 day range. And that means fulfillment by merchant. So that essentially means it's not coming in Amazon Prime truck. It's coming directly from the supplier's warehouse, the brand's warehouse, and it's probably going via FedEx or UPS. Both have their benefits. As a seller, you are probably not going to get as high fees if you're doing FBM the right way, just because Amazon's not charging rent at their warehouse. And obviously the good thing about FBA is, they like you as a seller, so they favor you in the beginning regardless. You get access to Prime customers, so there's more customers you get access to on the platform. Amazon loves it because they can control their brand, right? And it also takes liability off you. If a product shows up broken from shipping issues or the box is damaged, Amazon holds all liability on that actual process, so you don't get any kind of reviews on your business or anything like that. If we go to the next slide, we can jump through this pretty quick, but I just wanted to have sort of a visual here of the FBA supply chain. So you source the products with your working capital from the supplier. You then send those out to an Amazon's warehouse. You prep them at another warehouse potentially, or you can send them directly to Amazon's warehouse, depending where they're coming from. And then they become Prime eligible. And then Amazon pays you out bi-weekly on those actual sales. So that's sort of the FBA supply chain. If we go to the next slide here. So this is where when I talk about diversification and revenue models. So when someone is on this platform, it is important to make sure that you're sourcing products. You're not essentially just going down one route, because in all business, it's good to mitigate risk. And in order to do that, when you're selling online on Amazon or Walmart, you want to make sure you have a diverse product catalog, and that's also diverse in terms of where those products are coming from. Wholesalers do tend to run out sometimes around Q4. Last year there was some issues with that. So you can search wholesale. Wholesale is buying in large quantity from wholesalers in the US, getting at a volume discount and then flipping them on Amazon per product. An arbitrage model via FBM is actually buying from another supplier or a big box retailer, potentially like even sourcing it from a Target, right? And you're arbitraging that, sending it to a warehouse to repackage it, get it out of Target's packaging, and then pushing it directly to the customer from your warehouse. That has kind of a high movement on it, and there's a lot of money you can make from that side of the business. It's not sustainable to be a big part of the business, but it's a good way to augment some of the sales on these businesses. And then you have private label. This is what's going to really raise the value of your business. If you're looking at this as an asset that's going to appreciate over time. When you do private label, it means you are building out a brand of products. You are negotiating with a manufacturer. You're getting a branded product, and it could be in the homeware, the kitchenware, something along those lines. And you're branding it under your store name, which has proprietary aspects to it, obviously, which at the end of the day, if you're selling your business down the line, it's going to increase the value immensely. And so these are three things to make sure that if you are building a business on Amazon and you're doing it yourself, this is definitely the route to take. Obviously, capital allocation is important here because you have a lot of malleability if you're running through all three of these. And your working capital can be, if say the inventory levels are low on wholesale and private label is doing really well for that product, you can double down on that inventory, which the more inventory you purchase, the cheaper you get it at and the higher your margin may be. So this is what it means this is what I mean when I say diversification in product sourcing. Extremely important aspect because you don't want to be really just going down one route, because at the end of the day, if something happens to one of these sourcing models, or there's a gap in some kind of, some form of supply chain, then you can get affected across your entire business. So digital real estate, huge thing here. This is a term that my organization likes to use a lot, just because we have a lot of, we have almost 500 clients, but at the end of the day, actually about 30% of them are pretty serious real estate investors, and they see a lot of parallels between our industry model and real estate in general. Obviously it's not the same thing at all, but if you think of back in the day when the internet age was emerging, those domain names were forms of digital real estate. That's where digital real estate really first came into place, was thinking about, hey, if you just had something, if you had sourced socks.com, that's just an example, or towels.com, that would be worth so much money at this point, because it's a piece of real estate that cannot be duplicated specifically to what that is. And that is what this is if you do it the right way. These Amazon and these Walmart businesses are worth money. They age over time and they appreciate over time. There is a company right here, you can see right here, Thrasio, like a lot of what they have a $1 billion valuation, and their focus is on exactly this. It's flipping these kind of e-commerce businesses. We do it internally as well. If you were to even open up an Amazon business and get one sale, the first sale starts the aging process of your business. So you get one sale and say you just quit it, say, I'm not going to do anything anymore. You could most likely sell that store in about a year when you're in the next calendar year for like $3,000 by not doing anything besides having one sale. So if we look at a store that has wholesale contracts that are built into it, private label branding that is built into it, consistent revenue that is built into it, we're looking at 2 to 4x your actual net revenue or your net profits for that business that you could actually sell it for. And that's how we build businesses with our company. We always have in mind the idea of making sure that it is done compliantly and is done making sure that you have all different kind of models in there that are going to bring success to the business and bring value to it when someone's looking to potentially purchase it down the line. And that's a conservative value, 2 to 4x. It could be 3 to 10x if you have the right branded product. And so there's a lot of ways you can go with that. You jump to the next slide. So what is Amazon automation? So everything I just mentioned in general just now, like those are great, right? But it seems like it might take a lot of time to figure all that out. And so that's where Amazon and Walmart automation come into play, and organizations like ours partner up with investors. So most of our clients, investors, they come from all different backgrounds. It could be school teachers, retirees, veterans, real estate investors, you sort of name it. The commonality is no one really has time, but they want to diversify into a different asset class. And right now we see stocks volatile, real estate inflated, the economy in general right now is people don't know where to put their money. You don't want to have it sit during inflation. You still want to have it work for you, right? And where are you going to turn to? And so that's why people come to us. Even prior to this economic state, they want to get involved in this $5 trillion industry, but they don't have time to worry about how to figure it out, and they don't have the infrastructure. So this slide is pretty simple, but at the end of the day, the whole point of automation is, as an investor, you own the business outright. You pay a partner like us. We build, operate, and pretty much grow the entire business on behalf of you, leveraging our infrastructure. And there is an upfront cost to this, a one-time cost. So we handle management of your store, the logistics aspect. We have 2 warehouse facilities in Dallas, distribution, sourcing products, compliance, everything is happening with your Amazon business, and you own the business outright. It's 100% done for you. The only job as the investor is to be the financial driver of the business. So your working capital is going to drive sourcing the products, then in turn will drive the profit. It's a performance-based partnership on how we do things. So the only fees after the upfront cost with us, which is essentially an infrastructure cost, would be when we make you money as an investor. So based on how much you invest in the beginning, the net profit that your business will make month over month, we bill for a portion of that. And so we're incentivized as a organization and as in a partnership to make sure that your business is successful, because your success drives our success. And when you make money, we make money. At the end of the day, our investors have a lot of, some of them are intrigued by e-commerce. Some of them don't really care. They just want to, again, just diversify. So you can be as high touch as low touch as you'd like it as an investor. We have some investors we don't talk to for months, some that touch it, that, they touch base with us weekly. So it's really that kind of communication side is up to the investor. But this Amazon automation, the whole purpose of this is to really get people involved when they don't have the time to do it or the infrastructure for scale. If you don't have a warehouse facility if you don't have a warehouse facility and a team and all the data behind this, it'll be very hard to be competitive on Amazon's platform. And I could touch on that real quick right now. People think, hey, is it too late to get involved on Amazon? Are there too many sellers because there's 2.5 million in North America? Not at all, because most of these sellers don't really have the right infrastructure in place. And those are going to be the ones that filter out. So you can take that 2.5 million and cut that into a third. And a third of that is what's actually competitive to Ascend Ecom's clients, because we have an internal warehouse with an internal logistics team, an internal wholesale distribution network, which is all done and takes years to sort of develop. But by partnering with an organization like us, it sort of accelerates you into that ecosystem and puts you, into that top 20% seller in a matter of months. So just to sort of draw, and we can go to the next slide here. This is sort of a run through of our organization, just to get an idea of how these companies sort of work with Amazon automation. So with automation, you want to have a company that has a real infrastructure in place. And so we have warehouse facilities in Dallas. These warehouse facilities, if you are selling outside and doing this yourself, most of the time you have to leverage a third-party warehouse, which means you're sending your products to a 3PL center. There's zero prioritization. They're cutting into your margins, and it's a pain in the ass. And so how we actually work this business is, and why there's so much success here, is because we can keep our profit margin for clients very high, because everything is done in-house. There is zero outsourcing on anything that we do. And we have, a multitude of different softwares that we use and ways to actually source these products, because it's a highly evolving industry. There's trending products on data. There's historical data that shows on what's sold in the past, and seasonal data of what's selling in the cold winter months and stuff like that. It's very important to take that into consideration because it gets very, very complex. And again, on the idea of investing in a new asset class that people aren't familiar with, that's why we have a guarantee on everyone's investment. You invest with us, at minimum, you will make that back, and we'll pay you the difference. We have that in place because we're confident in how we can grow these businesses, and we've done it hundreds of times. You can jump to the next slide here. So this is sort of a timeline. If you were to invest with an automation company, specifically ours, obviously I can't really speak for every other organization that does similar things, but at the end of the day, your most work when you invest in an automation business is pretty much the application to Amazon, which takes about 20 minutes of your time, and then verifying your identity, which they do over a 10-minute Zoom within a week of applying. Once that's done, you fill out a couple forms on our side, which might take 30 minutes. And then it's sort of off to the races. You sit back and you let the automation provider essentially do everything for you. Month 2 to 5, we're building out a 6 and 7 figure business here. So yes, it does not happen overnight. This is a real asset that's going to last a very long time in a sustainable manner. And so the first 6 months are really building block months in this kind of business. But at the end of the day, if you look at your revenue in the first year, about 80% of that will be made month 6 to 12 after your first 12 months. And so that's when things really kick into gear in a business like this. Amazon, as a new seller, they put you in a probationary period. They don't favor you. They're sort of vetting you out as a seller. And so we have to gain trust with them. And there's ways to do that in the first 6 months, where they also open up more warehousing space for you and sort of intricacies like that, which our team will handle the entire time. The real goal for a investor here is to make sure that you have enough sufficient working capital, especially starting in 6 months. And when I say working capital, revolving credit lines that we leverage to source products, and then you get paid back bi-weekly by Amazon. You can pay that card down. So like a $40,000 business credit card, which can be utilized multiple times in a year, 5 to 6 times in a year, et cetera. And then, obviously the break-even point for most of our investors are somewhere between 12 and 16 months conservatively. We've as early as 10 months, as late as 18 months. It really does vary depending on what you're pumping into the business. And that's a pretty good break-even point for a potentially 40 or 50K investment, which is our sort of higher tier. And then at the end of the day, the way that we do this is we do have a 2-year agreement, but we do focus on, like I mentioned earlier in this, is the real estate aspect of this and the valuation aspect, and making sure that you have the flexibility to sell a business like this. That's why we have investors who buy portfolios. They want to make sure they have the flexibility where they can sell one and also keep one for passive income, which is obviously very important. And so I think for selling a business like this, 24 months is probably still premature. If you look at the 36-month mark, that's when you can open your doors and really post it on one of these networking sites to sell the business. We have an internal way of listing these. There's a huge network out there that look for these kind of businesses, but you can sell or scale. And talking about diversification again, that's important in terms of where your businesses are in e-commerce. Getting multiple stores, multiple Amazon businesses where you can have slightly different strategies on each, because they'll all have different trajectories. And then also touching on Walmart, which I'll touch on real quick right now. We all know Walmart, the massive retailer. Up until last year, they were the #1 retailer in the world. So they have essentially under 200,000 sellers because they just opened their doors to third-party sellers a couple of years ago. When I say open, like truly open. And so it's a huge opportunity. 2.5 million sellers on Amazon, under 200,000 sellers on Walmart. Walmart's got brick and mortar all across the US. Within 90% of Americans are within 10 miles of a Walmart. So what the pandemic did is it accelerated the inevitable, which the people that never shopped online at Walmart but went to Walmart every day are now comfortable shopping online on Walmart. And so their e-commerce has massive upside potential. There's obviously the issues because they're sort of a newer platform. You've got the tech has some advancement to do. There's less foot traffic than Amazon, but the margins are a little bit higher. And so we always push that as a second option. If you're a first-time investor, you get an Amazon business, and then you can diversify out to Walmart and get a piece of that early on, because that has there's a huge market upside there down the line with Walmart as well. So yeah, that's Amazon automation. Walmart automation is the same business model that we work with, but that's it as a whole. And again, this is very relevant given the state of affairs right now. Our company's been growing immensely, but at the end of the day, the conversations we're having with investors right now, it's pretty much very similar across the board of, looking to diversify out of what I'm traditionally doing, stocks and real estate, at least at the moment. And, what's more familiar than an Amazon investment? That's something we see every single day. But in order to tap into it and not take time away from your day, you have to look for a provider in the space that can provide everything that you'd have to do that would take years to build, including an infrastructure and the data behind it. So
you had mentioned 40, 50,000 and sell in 3-4 years roughly. So successful store. And I know it would be different for each one, but roughly how much are they selling for?
yeah, so you're looking at, if you have a store that is, let's say it's making 10 grand a month in net profit, that's net, right? Say its revenue is roughly like 80 grand a month or something like that. Those stores are generally, depending upon, obviously there's so many different, ways these stores can be built. When I say like, it could be more private label heavy than wholesale, but on average, with making 10 grand a month, that's 120 grand a year in passive profit. Essentially, if you're with an automation agency, and you're looking at 2 to 4x that. So, somewhere between, the 2 to 500 grand price range. I did the 10 grand because it's simplicity of math. I'm not really that good at math. But that's the best way you can sort of look at it, is your actual net margins as a profitability standpoint for your store, and then 2 to 4x that. And we've seen upwards of 10x if you have the right private label product that's built in there, that's doing, really well. That keeps increasing the value.
Awesome. And this is the best way for people to get a hold of you here?
Yeah, so our website is www.ascendecom.com. You can always book a call directly with us then. Please mention that you came from this webinar as well. We might be able to help out a little bit further on some discounts on some stuff. But at the end of the day, you can follow us on Ascend's social channels, emails, partnerships at Ascendecom, at Ascend_ECOM. That's our Instagram. We have a lot of updates there. We post regularly about industry highlights, our new facility opening, business models, and stuff like that. Our calls, if you set them up, are very, very educational purpose. We're not here to push any kind of, we're not salesy like that. It's learning about your background, what drew you into this, what you're looking for, et cetera. How does it line up? And if it makes sense to continue the conversation, we sort of take it from there.
Awesome. How much time does an investor need to spend on this investment during the average month?
Yeah, after the first month, I'd say the first month is like an hour, 2 hours. Honestly, it's at your leisure and checking in. So you want to make sure that your working capital, you're paying down your cards as you're getting paid out from Amazon. That's just a financial thing. In terms of checking on the business, we have a portal that has direct line communication with store managers and our business, as well as analytics on what's getting purchased and where your revenue is going, and net profit, which we do all that bookkeeping for you. So you can check in on it and ask questions, but it's really up to you on where your involvement wants to be, because it can be, honestly, as high touch or as low touch as you'd like. I'd say on average, clients check in like once every couple of weeks, maybe 10 minutes, 10 to 15 minutes every couple of weeks. The whole point, it's as automated as possible. In the beginning is the most work you'll do.
Great, thank you. What's the average ROI that your investors have achieved?
Yeah, we're looking at, on average, roughly 20%. That's where we like to put it in the beginning. In the beginning, you're getting probably lower ROI because we want to get traction on your store. And this is return on investment on products I'm talking about. So if we're sourcing 10K of products, et cetera, the margins might be lower because we want to get your store traction. It might be in the 8 to 10% range. But once your store scales up and it has clout on the program, on the platform, we shoot for products 15 to 35% ROI on those products. In terms of the full business aspect, you're going to break even on that initial investment in the 12 to 14 month range. We like to underpromise and overdeliver. Sometimes it's a little bit earlier than that. Again, that's going to dictate how much you're spending. If you're putting 10K in product, you're getting 2K in profit out of that. you get 12K back, et cetera. The more you're putting in, the more you're going to get returns, once we get past that first 6-month mark.
Thanks. What's the minimum investment for a store?
Our lowest program is 20 grand. So and you can purchase up to some extent. We actually are rolling out some programs that might be a little bit lower than that, but our entry point is 20 grand. That's a 50-50 net profit split. 30 grand is a 60-40 profit split. So 60% to the investor, 40% to us. 35 grand is 65-35, and 40 grand is 70% to the investor, 30% to us. And you can also purchase up to 75-25 after 3 months. And that's, again, you look at it this way, it's everything is done for you. So you do own it. And this isn't the ownership of the store. This is just commission off the profits that we're making. You own the store 100% outright. So the asset is yours. So we're just a contractor.
Great. What are the risks of this investment?
Yeah. So the biggest risk in e-commerce, especially selling on a third-party platform, is pretty much it's inventory. So, we're very, very conservative in the beginning. We're not going to drop like 30 grand on one product at once. We diversify what we're purchasing with low MOQs, minimum order quantities. So at worst case scenario, we might buy 5K of a product that sits a little bit longer than we want it to sit and doesn't sell as fast as we'd like. And maybe Amazon comes in and undercuts us, right? They're the only ones that we can worry about competitive wise. If they undercut us in price, at worst case scenario, what we do is we just liquidate it out and run PPC ads out of our pocket to it, and you break even on that investment. And so holding product longer than you'd like is the biggest risk, which we have obviously plans in place to make sure that no one ever loses money on product. If we come to that scenario, we have ways to get out of it. That's probably the biggest risk. Also, you are on a third-party platform. We're doing absolutely everything compliantly, but you're on Amazon's platform, right? And so sometimes, very, 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 very rare, especially if we do FBA and Amazon Prime, sometimes when a store starts to do really, really well, they like to pretty much pause the store and do a suspension audit to make sure you're doing everything compliantly, which we are. So that doesn't last too long, but that might put things on hold in the beginning. With age, these stores get messed around with less by Amazon, but Amazon's very big on making sure that there's not fraudulent sellers and their customers are first, obviously, right? Not the sellers. So, they will algorithmically sometimes randomly do that. But I'd say those are the two biggest risks. At the end of the day, the biggest risk would be inventory hold times being longer than you'd like, which we have a way out.
I have some other good questions here too. Does the investor have to decide on what products to sell, or do you manage all of that for the investors?
Yeah, we do it all. So if you don't have to worry about literally anything besides providing capital. It's all data driven. So if you look at a business that, let's just say John Doe has been with us for 6 months, and we look at his Amazon's business and what he's selling, it could be anything from food to Dyson vacuums to motor oil to potentially supplements to Barbie dolls, gardening supplies. It's everything across the board. Every store is a general store, so we don't niche down, and so we're just selling what's going to make you money. Because we have some clients that don't want to sell certain things, we cannot sell certain things for you. Other than that, we just go with what's going to be profitable, and it's just data driven. If we go down the private label route, which is an add-on to our regular business model, private label is us building out a brand for you. There is some flexibility. Say you have a passion for cooking and you want to go down to the kitchenware line, we can do research and develop a private branded product in that line if we find one that fits our metrics for profitability. And you can be a little bit more choosy on that if that's something you prefer. But the short answer is no. It's pretty much just a base model that we handle everything A to Z.
Can an investor scale up their business quicker by leveraging financing beyond the initial line of credit to purchase more products / scale?
To some extent, I will say that Amazon, so if you're a new seller, Amazon does do inventory limits, right? If we're doing FBA. So sort of like if we compare someone who's got $500,000 in working capital to someone who's got 20K in working capital. On the first 3 months, they're going to be probably on the same playing field, just because we simply can't buy as much as we'd like, because Amazon says, hey, you're a new FBA seller. We're not going to just give you all this warehouse space, so we don't know if you're legitimate or not yet, right? So you do have to somewhat earn your stripes the first 3 to 6 months, but 6 months after that, yeah, the more working capital you have, the higher trajectory, the better trajectory you're probably going to have, because it means you're going to get more volume discounts on wholesale products, which means your margins will be higher. And we also have more wiggle room, where if we find a product that's got 8 to 10% margins, but the volume is crazy, say it's selling 500 units a day, we're not going to buy that for someone who's got lower working capital limits, just because there's less wiggle room and there's more of a ceiling with them. Someone who's got 100K in working capital, we will purchase that, because at the end of the day, a margin's a margin and profit's profit. And if they've got that much working capital, we don't have to be concerned about spending on that if the units are getting sold like that kind of volume. So there are obviously the benefits to having more working capital. And then there's also the idea, sort of long-winded answer here, but we do have some clients that come to us and they've got very, very deep pockets of working capital. And they're asking us questions about being $500,000 into one store, et cetera. I always go in a response when it comes down to this is not putting all your eggs in one basket with these kind of businesses. At least have 2 businesses running and spread that working capital wealth out. It goes back to that diversification aspect I mentioned, where you're covering more ground, you're getting more product mixes on your store, you're mitigating risk. So having a portfolio when you reach a certain working capital limit is probably the smarter move, but obviously it depends on the kind of numbers we're speaking.
I think you kind of answered this before, but do you choose the niche or investor's choice? Do you give advice on this?
So a general investment without private label, there's no niche. It's general, right? So we're selling, like I said, everything: food, automotive parts, you sort of name it. So it's everything across the board, and we're picking those products. If we go down a private label aspect, which is an add-on to that model, where we can build out a brand, then we can work with the client if they want to go down the fitness route, or they want to go down, something specific. We can pull the data and see if we have manufacturers that find a viable kind of product in that niche. Other than that, no.
Okay. Can an investor get started with 20K and add to the capital later?
Add to the capital as in purchase up to a higher profit split, or if that's what they mean, then yeah, you can buy in later on. But at the end of the day, there's and also for working capital limits, let's say our most common plan is the 30 and 40K plan. But if you are doing, for example, if you're working capital, say you want to buy a 40 grand store and your working capital is like 10K at the moment, but you're working on expanding your business credit, we can still start with you with minimal working capital. The goal is to make sure that you can at least match your upfront investment, have at least 30 grand of working capital by the 6th month to have a successful business, because that's really when the wheels start turning. So we can start with, hey, say you only want to spend 5 to 10 grand the first 30, 60, 90 days while the store scales. We could be pretty nominal in our spending in the beginning as we age the business. It's really focusing on the second half of the year is when you really want to make sure you can pump money. And so our hands aren't tied in terms of scalability.
Great. And did you say when they do this, like you can use a credit card as well, or no?
Yeah. So for products, we want you to use credit cards. I mean, it could be a whole other webinar, but I'm sure a lot of your listeners are familiar with business credit. But we have people who come in with personal credit in the beginning, but the whole goal here is to make sure you open up an entity, new LLC for the business, open up the Amazon store, get yourself a business credit card, right? One at 0%, maybe one charge card. That charge card is going to be what is paying for the profits. If you want upfront for us, we take liquid for the upfront payment. You can pay in card. There will be a 3% fee there. I don't really recommend that. Save your credit limits for working capital. But yeah, you have a $30,000 credit card. That's what we use revolving on your products, right? It's way better than using liquid. You always want to leverage the bank's money, obviously. And if you could do it at 0%, specifically with the business card, you're getting all the points from that. You're paying it down. We're selling and getting paid by Amazon bi-weekly. it's cyclical. I mean, I have 4 of my own businesses and Amazon and Walmart. I love to travel. Me personally, I was in Europe the last 3 months. I did not pay for literally one hotel or a flight. Just stacked up the points on my Amazon or my Amex Platinum. But you can do cash back. You can do obviously grocery. It's whatever. So the huge benefit of using credit, 100%. But yes, you can use credit for both payments. But we recommend using it primarily for the working capital aspect, which is pretty much leveraging it for products.
For the basic store of 20K initial investment, how much working capital does one need?
Yeah, so I mean, you can honestly, the goal here is the 20K business. Like, let's have you have maybe 20K working capital by the second half of the year, which you can help our clients get. But you could start off with $5,000 of working capital, honestly, in the beginning. It's not, and you can even start off with a 40 grand store at 5K. But at the end of the day, we need to make sure that that you can acquire more. But the first 6 months are slower regardless, and so it's not a huge concern to have massive credit limits in the beginning. We have some stores that start doing well on month 4, but you can sort of just generalize it by saying the first 6 months are a building block phase, and we can work with whatever credit you have at that period of time. But to be truly successful and to make you break even on your 20K investment, let's get you into like the roughly 15K range in working capital for month 6 to 12.
In terms of legal and accounting, do you have to start a new LLC?
You don't. I'm not a CPA, so I don't want to give too much advice here, but it could be messy if you've got an operating business and you're using like a real estate investment entity, because the amount of volume that we're doing on these stores is pretty intense once it scales up. A lot of purchasing, a lot of stuff going on. So I'd always recommend a new entity, and it doesn't hurt to get new entities. They're extremely beneficial down the line because you can open up more business cards and get more incentive bonuses with Amex. I mean, I've got like 14 entities myself. I'm really only primarily using about 4 of them. The other ones I've opened up for business card purchasing to make sure I can get these bonuses and then leveraging them on other businesses. But yeah, I mean, we also have a partner in the space. They're called Blue Books, BLU books.co. They focus directly on Amazon entrepreneurs. We get you a free month there and I believe 10% off, but they're pretty affordable regardless. But this is a very niche kind of accounting side of things. And so they're very good at making sure that everything's aligned for you and automating the kind of like process for bookkeeping on this. So you don't really have to worry about much. The short answer is yes, you can use any entity you like. Is it recommended? I wouldn't do it just because this business is going to grow and have a lot of purchasing, and your accountant might say, what the hell are you doing? This is giving me a lot more work than I want, because it's sort of muddying the waters between another entity that's cash flowing. But yeah, it's up to you.
Awesome. How much is the initial setup cost?
Yeah, that setup cost is what that upfront fee is. So 20 to 40,000.
Gotcha.
That's a one-time fee. We do not do renewals. That's a one-time infrastructure fee that goes to payroll, leveraging, our 30,000 square feet of warehousing that we have in Dallas. We also are extremely transparent. You can come there, if any of you guys are in California, you can come visit us in our Los Angeles office, which if you're watching this, that's where I am right now. You can also see the nuts and bolts of the operation in Dallas. We do warehouse facility tours all the time. So for prospective clients and for clients that are with us, so you can sort of go into the warehouse and see where the magic happens, but even checking on your products in the supply chain aspect of that. So we're all about transparency with investment because it is a digital investment, but we're traditional in the fact that you can come shake our hands and sort of see what's going on.
The next question was, can these really be done within our IRAs? I guess sorry, go ahead. Go ahead, Will.
Yeah, no, please sort of break that down a little bit more to me, because I want to make sure I'm interpreting that right.
Yes, and again, I'm not an accountant or anything, and this is a new space that I'm learning about as well. Yes, you can make the only thing that the IRS prohibits you from investing in is collectibles and life insurance. Now, depending on this structure, I mean, obviously everybody that has a business would put their business in an IRA. This may have UBIT, but if you did it personally, you'd be paying taxes, obviously. And especially if you're a high earner, you may actually save it because IRAs are taxed at trust rates. And what you'd want to look at or talk to your accountant about is UBIT. That stands for unrelated business income tax. So if you're running a business out of your IRA, the IRS says, you know, you have to pay taxes. But to answer the question, yes.
I guess you answered for me.
But we can look more into that too. So, but that was our last question, unless anybody has anything. Oh, nope. Sorry. Is there one more? Can you use an HSA? Yes, an HSA, the rules are the same, you know, aside from contribution limits and stuff, but yes, you can use an HSA as well. But that is the last question that I see, unless anybody has anything else they want to add. Well, I appreciate the information, Will. This is very interesting. And thanks for taking the time out of your day to give us this information. Thank you very much.
Yeah, no, it's been a pleasure chatting with you guys. And like I said, if anyone does end up sort of reaching out to us, make sure you mention Gamma Plan. Because we might have a little bit of an incentive there for you guys. But anyway, yeah, it was great chatting with you guys. I hope to come on again in the future.
All righty. Thank you. Have a good day.
All right. Take care. Bye-bye.